Hey everyone, in today's video, we're going to go through 18 stocks that have been absolutely roaring in the last month in the stock market. Since we're going through so many names, we're just going to go through what these stocks are, what their EPS has been for this year, how much they've been going up, and what their outlook is. So we're going to go through these pretty quick. If you like this kind of content, be sure to give this video a big thumbs up, but we're going to get right into it. The first stock here is Chipotle. Chipotle's up over 6% in the last month alone, and it actually recently just hit its 52-week high. Looking year to date on this one, it's up almost 70%, so this has been a huge winner in the QSR space. With that being said, looking at their trailing PE, it's at about a 55 here. So definitely paying up for the value. They're going to do over $50 a share next year. So they're trading at about a 45 times forward earnings. So, great growth, great company, great expansion plan. Definitely in trend in terms of the momentum that they've built. But this one's definitely trading at a pretty high multiple for a QSR restaurant in the mid 40s here. Going to go into stock number 2 here, Paramount. Paramount's had a great month, up 33% here. Unlike Chipotle, longer term, this one has not been performing as well, down about 14% on the year. In the last 5 years as well, this one's been trending down. They've paid a dividend throughout time. Looks like they've lowered it recently, but this last month, they've had a lot of unique drivers other than just the market. Number one is the rumor or speculation that they're in talks with Apple TV to pair together their streaming services. That has built a lot of momentum in the company and the potential ability for them to make their streaming service profitable. And then there's just lots of other rumors going on with the company. Lots of people thinking they may be privately shopping around their studio, thinking their stock price is undervalued, trying to monetize or crystallize some of the value. So just lots of the rhetoric behind that has got the stock price up. Once again, in the last year or so, though, still trending down despite this 30% jump that we've recently seen here. In terms of EPS, this one here is expected to do about $1.20, so trading 13-14 times. Last year they did 70 cents, the year before $1.70. So they're kind of all over the place here, trading somewhere between the mid-teens and the mid-20s, depending on the year and accounting and stuff like that. So definitely not a dirt cheap stock, but not trading at an expensive valuation like a Chipotle or something like that. On to the next one, we have EQ Bank up almost 20% in the last year, or in the last month. This one has been a huge winner longer term, up 50% in the last year. The last 5 years, up almost 200%. And this is compared to lots of the big banks in Canada that have been struggling. Some are actually down over the last 5 years. So this is a primarily digital bank. They have an app that they offer lots of services like GICs, loans, checking accounts, credit cards, stuff like that. And they've just been growing extremely well. They pay about a 2% dividend, but they've actually been increasing their dividend almost on a quarterly basis. And in addition to that, they still don't trade that expensively, even though they're up almost 50% on the year. Looking at their EPS estimate here, EPS for next year is at about 13 times. So they're trading at about 7 times earnings, give or take here. So if you bought this stock a year ago, they would have been trading closer to $50 a share, doing $13 of earnings in 2020 in the next year. You'd have bought it at a 4 PE come the end of the year. So definitely one that keeps growing. Analysts and investors keep underestimating its growth profile. We'll see if they can keep it up. Still trading at a pretty good valuation here, though, despite the all-time highs it's pressing up against. Next stock here, we got Marriott, and we got lots of travel-like companies. Marriott here is at a 52-week high at $220 a share, $65 billion company, so definitely a huge company. On the year, up almost 40%. So lots of these that have rallied in the last month have actually just been rallying all year. They've been great investments so far this year. They pay a 1% dividend. Looking at their EPS estimate here, they are at about $10, a bit under $10 for next year. So trading at a forward earnings of about 23 times, a trailing earnings closer to 30 or high 20s. So not that cheap on this one. You're definitely paying up. They get lots of revenue and profit from all over the world, so they're very well diversified. They also have somewhat of an asset-light model because they do franchise out lots of their brands to hotel operators where they're just collecting those royalties, which are a great passive income stream. Jamieson Wellness is the next one we're going through here. In the last 1 month, this one's up over 10%. The last 6 months here, not doing as hot. And year to date, this one's actually down. It dipped extremely heavily throughout the summer into October before just skyrocketing up pretty much 50% in a month, give or take. So this one's definitely been a volatile one. Pays about a 2.5% dividend yield here. Looking at their EPS, their stock price is $31 a share now. Their EPS for the year is about $1.60. So they're trading just under 20 times current year earnings. Next year, they're anticipating to grow about 10 to 15%. That probably is there. So they're probably trading at about 17 times next year's earnings here. A bit of a unique one here. We got Abercrombie and Fitch up almost 25%. I thought these stocks were dead in the water a while ago when they were trading at 3, 4, 5 times earnings. But look at this, $85 a share. In the last year, this one's up almost 300%. So this one's definitely been revitalized. If we look at their EPS on Abercrombie, expected to do about $5.50. So it's actually trading at a pretty decent multiple here. Right around 16, 17 times, essentially a market multiple for a apparel company, which is, in my opinion, quite expensive given the cyclicality and the challenges, competition in this space. So definitely interesting to see the huge run up. I'm sure there's things behind the scenes and other growth opportunities that they're pursuing that I don't know of, just looking at the ticker and the stock price. But just very surprised to see this one roaring to the extent that it has here. Just a reminder as we get through these stocks, if you like this kind of content, be sure to give me a big thumbs up. It helps a ton with the YouTube algorithm. If you haven't done so yet, consider subscribing to the channel as well. We do a lot of these videos about stocks. We usually go deeper and talk about less stocks, but this video, just so much going on that I wanted to cover a lot of these names that have been exploding. Next one up here, we got Expedia. Expedia is up 20% in the last month, up 60% in the year. So lots of these travel companies, we already did Marriott, Expedia, we have a couple more on the list. They've just been absolutely exploding throughout the year. I think one of the things is throughout the year, there was lots of sentiment that lots of these travel companies would not be able to do as well in the upcoming economy. Rates going up, discretionary spending going down, interest becoming more of an issue for consumers. And that kind of held these stocks down despite improving fundamentals and earnings profile. And then in the last couple months, it seems like that hard landing that the travel industry was concerned about has not actualized and is not really anticipated to actualize to the same extent, with rates potentially coming down next year. And they're just capturing all of that upside. We see that here on Expedia's chart. In terms of their EPS, they actually are doing phenomenally well. So they did $7 last year, doing $9.50 this year, expected to do over $12 next year. So this stock's only trading at about 12 and a half times next year's earnings, despite that huge run up that they've had. S&P Global is another one here in the last month. This one is up as well. Just taking a second to load there, but up about 9%. Year to date on this one, up 30%. S&P Global reported their earnings in the month, did very well across lots of their business lines. This is the company that owns lots of the indexes like the Dow Jones, the S&P obviously. They also have tons of other analytical and big data businesses that they sell data to investment firms and stuff like that. And obviously they have their credit business. Them and Moody's pretty much has a duopoly. So lots of businesses with high margins, high moats, tons of cash flow flowing through that they reinvest for future growth. And it does trade at an expensive valuation though. So looking at this one here, $440 a share, expected to do under $15 a share next year. So trading over 30 times, about 31 times next year's earnings. Definitely a pricey one, but sometimes you have to pay up if you want quality. Couple Brookfield companies here. First one, Brookfield Renewable, up over 15%. There's been lots of talks in the world right now about strategies to pivot away from fossil fuels, oil, over the long term. And that's kind of been more formalized at these world summits over the last month or so. And I think that's one of the reasons why Brookfield is jumping up 15% here. Not necessarily an earnings story behind it yet. You can see here their EPS is not phenomenal. With that being said, I do think they have lots of capex, so this may not be indicative of their free cash flow. But this is really just a sentiment change and and more bullish case on renewables at large, I think, which is pushing up Brookfield on the year, up 15% here in the last month. And then we have Brookfield Infrastructure, which is really just rallying up primarily because of how interest rate sensitive these infrastructure stocks are with the amount of debt that they carry on their balance sheet. So up 14% on the month. However, still down 10% on the year. And once again, their fundamentals, I believe, throughout the year have actually been pretty solid. It's really just the interest rates, the comparative opportunity of going into GICs and treasury bills, as well as the debt servicing cost increase and that lag on earnings and free cash flow as well. But overall, nice to see them recover a nice chunk in the last month. Looking at their funds from operations here, you can see they did about $2.16 in the first 9 months of the year on a run rate to do close to $3 USD. So close to 375, let's call it, close to $4 of Canadian. So they're trading probably 12, 13 times current year earnings on Brookfield Infrastructure Corp. Next stock here is Costco. And Costco, I believe, just hit an all-time high recently. You can see they're up over 30% on the year, up another 8% on the month. And this one continues to be an expensive stock, but it's been an expensive stock for over 5 years. And if you bought into the expensive stock 5 years ago, you'd be up over 200%. So sometimes expensive is relative. The PE is indicative of the growth profile a company has. So let's look at it forward looking here. They're going to do about $17 a share. So it still is expensive. Looks like it's around 40 times earnings, give or take, by my quick math. So really expensive for a retailer. Lots of other retailers you can get for 14, 15 times earnings. You're paying more than double for the earnings profile of Costco because of just their history, their defensiveness, their growth rate in the past, and their future opportunities to continue to grow. Back to travel. We got Booking Holdings here up 9% in the last year. This one just hit an all-time high too, up 72%. So we had Marriott, I think, was up 30, 40%. We had, what was the other travel company? We had Expedia up 50% on the year. Now we got Bookings up 70%. So lots of these travel companies doing phenomenal in terms of their earnings profile here. Expected to do $175 a share, so about 20 times next year's earnings. Definitely more expensive than Expedia, but not as expensive as Marriott. So it's kind of in the middle there. And keeping the travel train going, we have Airbnb here. It's been super volatile over the last year, but up 17% in the last month alone. Year to date, up 75%. So even a bit more than Bookings. And Airbnb trades at a higher multiple, has a higher growth rate, so it's a bit more sensitive to interest rates just because they have to calculate the net present value of future earnings. That increases the value of the company as interest rates go down, decreases it as they go up. Looking at their earnings profile here, over $4 a share this year. So trading, in the 30s now, 33, 34 times. Ignore the 2023 number. I think there was a tax dynamic here that got it up to $7.50. They were closer to $3 of EPS, I believe, in actual terms, $3 to $3.50. Okay, getting close to the end here. We got Manulife. Manulife up 10% on the month here. Still got a nice dividend of over 5%. And in terms of their PE ratio, it's pretty low, similar to other financials. This one's trading at about 8 times next year's earnings of 364 right now. So yeah, another one that's a bit cyclical, has a lot of competition. But generally, I feel like these financials, specifically Canadian financials, pay you a really nice dividend, continues to buy back shares, continues to grow their earnings profile, and they trade at these dirt cheap valuations. So it's really interesting to see. This one's realized some value in the last month, up 10%. And another Canadian one here, Canadian Pacific Kansas City. So this was a merger between Kansas City Railway and Canadian Pacific. The last month we're up 6% here. In the last year on this one, I think it's been a bit back and forth, let's call it, down 3%, but you can see pretty stable, up, down 5% here or there. Just kind of went down the last few months before rallying in the last month. Their earnings profile is about $3.30 a share. So they're trading at about 24 times next year's earnings, let's call it. A bit pricey, in my opinion, for a railway. These are great businesses, great moats, really hard to compete with them. in terms of laying down new tracks. No one's really building new railways now, but still the value is probably on the higher end of what it's been historically. And we're going to end off on 3 REITs because REITs have been absolutely cranking the last month. They've had a terrible year because of interest rates, but in the last month here, up 11% on realty income. Going into a couple of Canadian REITs here, Riocan, which is a retail REIT in Canada, in the last month here, you can see they were at $17.50 a share. They're now at $19, so a nice 10% gain. And the last stock we're going to go through is Allied Properties. This one has gotten absolutely destroyed in the last number of years, from over $50 a share down to about 15, I think it got to. They own premier office buildings around Canada. Obviously, office is not the place to be. Investors have not really wanted to invest there. But in the last month, you can see this huge push from $16 a share to over $20 a share, about a 20% jump in the equity share prices here in the last month, and you're still getting over a 9% dividend yield. They're expected to do about $2.25 of funds from operations, so trading about 9 times earnings. Looking at the earnings multiple of some of these guys, Realty Income does about $4 of funds from operations here, so trading at about 14 times earnings at these levels. And then Riocan does about $1.80, so trading just over 10 times after the rally here. Okay, we got through those pretty quick, so I want to thank you guys if you made it all the way to the end. If you did make it all the way to the end, leave me a comment below. Not too many people do. Also, be sure to give this video a big thumbs up and consider subscribing to the channel. I really appreciate your time here, and I'll see you guys in the next one. Thanks.